20,000 from the head office was included in the director's emoluments. The interest was to be treated as received from a thinly capitalized company. So it's about interest on loan. Is it P&L? Yes. We are told it is included in the director's emoluments. Is the interest on loan allowable expense? Yes, it is. But now, they are talking about the interest being treated as received from a thinly capitalized company. Now, there's something called thin capitalization. Thin capitalization we are going to look at. Yeah, there's a topic about tax planning. In the tax planning, there's something called capital structure. We'll learn more about thin capitalization there. However, at the moment, because we may be using it before we get there, what you need to know is this. If an expense is paid to another related company, and that other related company is located outside Kenya, the related company can be a subsidiary, a parent company, a joint venture, or an associate, which is located outside Kenya. That expense is not allowable. According to the government, that expense can be used to evade tax. So where is the connection with the thin recapitalized? Now, when you get there, we are going to learn, when you talk of thin capitalization, it's what I have just explained. Being paid to another related company located outside Kenya. That expense is not allowable. So this is not allowable, and it is in the director emolument, which is in the P&L. We disallow it. So interest on loan, in bracket, thin recapitalized. Point number 7 is the last point in that question, in the additional information. So that tells you that we are at the end of the items that we are supposed to add. Now we come to the items we are supposed to less. There are usually 3. So we need to go to the question and look for non-taxable operating incomes in P&L, meaning these incomes that are in the P&L, any that is non-taxable, we deduct, because if it is in the P&L and it's not taxable, it increases the net profit that we ended up having down there. Not taxable, we deduct. We also deduct all investment incomes in P&L. If there is an investment income here, we deduct so that we remain with operating income. That is what we said. And then in the end, we are going to look for allowable expense not in the P&L. Expense that are supposed to be here to be deducted to get the net profit, they were not deducted. Those we saw, we are supposed to go to the additional information. So we start with the incomes in the P&L. We look for non-taxable and investment. The first income is the gross profit. Gross profit, we say that is supposed to be a taxable income. However, there is an additional information on it. Additional information number 5, which say gross profit was overstated by 20% and include figure for purchases of 340, which had been understated by 15%. And we saw that when you overstate the gross profit, the net profit down there become more. So this net profit here is overstated. So we need to deduct that overstatement of the net profit. So we come here and say gross profit overstated. The gross profit is 11,520. And we said, when you're told it's overstated, you know, most people make a mistake of less. Like now, we are told it's overstated by 20%. So they just take 20% of that figure. No. We said you look at it this way. If it's overstated, this figure must be at 120%. And what do you want? You want the overstated percentage, the 20%. So if this 120, 20% will be equivalent to what? So cross multiply, it will mean that you multiply by 20 over 120. So 11,520 profit. So purchases. The purchase will be. Now again, if it is understated by 15, it means that we take 100 minus 15. That's 85%. So that means that this figure is 85%. And what do we want? We want the understated percentage, the 15% times 15 over 85. 340,000 times 15 divided by 85. After that, we go back to where we were. Remember, we are still in the P&L looking for non-taxable operating income and investment income in that P&L. So the next one after the gross profit is foreign exchange gain. For the foreign exchange gain, we said it's always taxable unless you are told unrealized. It's always taxable. So that's okay. Next one is the dividend from Hazina Cooperative. we said that dividends are investment income. And here we are saying all investment income must be deducted. So dividends, hazina, cooperative, that must be the society, which we have 68. And we normally deduct the amount that was added. You see, somebody may say, it is net, let me gross it up. Don't. You deduct what was added, whether net, whether gross. So what was added is 68, so deduct the 68. Another one is the dividends from subsidiary company. Another investment income. Dividends are investment income. So dividends, subsidiary. $244. Now that is the last income that we have in the P&L, and that means that, you know, the first part are over. The non-taxable operating income in P&L or investment income in the P&L. Now we look for allowable expense not in P&L. An expense that was supposed to be deducted in the P&L, it wasn't deducted. So it means that now the net profit that we are having is more. So we need to deduct. So it is not in the P&L. Where do you find it? You normally find it in the additional information. So we go through the additional information, look for allowable expense not deducted. The first additional information, number 1, says the company operates in a factory building whose construction cost at the time $1,800,000. Now, is that cost in the P&L? Yes, we are told the cost of this building is included in the director emolument. Director emolument is in the P&L, so we are not interested in that. We go to the next one on the same point. The company installed a processing machinery costing $2,800,000 in year 2016. Is that cost in the P&L? No. We are not told that is relating to any expense in the P&L. Is it allowable? No. Why? It's a fixed asset. What do we allow for the fixed assets? Capital allowance. Which one? Is a processing machine. Processing machine, we said we claim investment deduction. How? This. If you look at what we said when we were looking at the capital allowance, we said that investment deduction first year. So in this case, which year are we in? We are in the second year. We changed, we said 2016. So it was acquired in 2016. We are in the second year of 2017. So that means that we take 25% of the original cost, which allowances are on a reducing balance. You have to minus the capital allowance of the previous year. So what was the capital allowance of the previous year? It was only 2016, where the capital allowance was 50%. So 50% of 28. So this will give us the written down value and then 25%. So we start with 50% of 2,800,000. That is going to be 1,400,000. So that being the investment deduction of the first year, the written down value would be what? 28 minus 1,400,000 give you 1,400,000. So we take 25% of 1,000,000. After that, we go to point number 2. Because additional information, number 1, we have exhausted for allowable expense, not in P&L. Number 2, on 1st July 2017, the company acquired portable packaging machine. So those costs, again, they are not in the P&L. But are they allowable? No. Why? They are fixed assets. Fixed assets, we claim capital allowance. So we need to know which ones for each one of them. And we start with the portable packaging machine. If you go to the capital allowance, we said packaging machine is a machine that assists in manufacturing. A machine that assists in manufacturing, ID of packaging machine. And which date are we supposed to use? It is the first year, July 2017, that year. And we don't consider time. We say that because it was 1st July to the end of the year, those are, we don't. The computer, we have 240. %, of 240,000. That gives us 60,000. Then we continue. After the computer, there is weighing scale machine. For the weighing scale machine, that's supposed to be weigh and tear. Which rate? 10%, and it's the first year. So we claim that is 4,817. The company put into use a staff canteen constructed at a cost of 780 and a go down whose cost was 600,000. Now, other fixed assets, are they in the P&L? No. So we claim capital allowance. Which one? If you go to the capital allowance, we say staff canteen, IBD. Go down, IBD. Which rate? 10% on a reducing balance. But this is the first year. And we don't consider time. We say that because it was from 1st October 2017, we consider 3 months. We don't. It's a full year. So, industrial building deduction, what we call IBD, of, we start with the first one, staff canteen. So that is supposed to be, that is 78,000. The other one is the go down, 10% of 600, that is 60,000. So for point number 3, done. We go to point number 4, legal expense. Is it in the P&L? Yes. Remember, we are looking for expense not in P&L, so we leave that out. Number 5, there is no expense in number 5. Otherwise, they are also in the P&L. Director, number 6, director allowance, is it in the P&L? Yes. Number 7, interest on loan, is it in the P&L? Yes, because we are told it's in the director's emoluments, which is in the P&L. So seems like we have run out of the allowable expense not in P&L, but not so fast. Why? Because we said once you are done with the additional information, that require wear and tear at the rate of 10%, computer software, wear and tear to invest, ID, investment deduction. And this, if you look at additional information, number 1, that's where we were told, it was acquired in 2016, last year. So that means that it must be on a reducing balance, and there isn't any other fixed asset that we had added back. So we claim the capital allowance for the 3. So 10% of 360, that is 36,000. The other one is the wear and tear on software, 25% of 90. %5 of 90,000 give us 22,500. Then we have the factory building. So that we said is ID, investment deduction, for factory building. And since it's the second year, you know, it was acquired in 2016, and now we are in 2017, we take 25% off. The original cost was 4,800, and now first year, that is 2016, they claimed 50% of that 4,800. This gives us to 400,000. So 4,800,000 minus 2,400,000, that gives us 2,400,000. Then 25% of it, 400,000, give us 600,000. Now that there is no other fixed asset that we need to claim the capital allowance, what do? We can now get what we call the net taxable operating income. So we start from here. The net profit, we add the ones that we are adding, we minus the one that we are minusing. So we start with 2957, 500, and then we add 250,000, and then we add 25,500, we add 120,000, and then we add 375,000, and then we add 4,800,000. We add 27,000, add 36,000, and then we add 19,800, and then we add 94,000. Let me confirm that. Yeah, 94,000. And then we add 495,000. And then we add 96,000. So that gives us 9,798,600. And then now we minus, and then we minus 60,000. We minus 68,000. We minus 244,000. Then we minus 210,000. Then we minus 60,000. We minus 4,800. We minus 78,000. We minus 60,000. We minus 36,000. And taxable operating income for the company. And we said, since it is positive, you don't stop there. You add taxable investment incomes for the company, because you normally tax the company on its own income. So, do we have the investment income? Yes, they were two. In our income statement, we had two dividends. One, dividend from Hazina Cooperative. Now, that is a cooperative society. If you go to the categorization of dividend, we said, dividend from a cooperative society other than SACCO, it is a non-qualifying. Withholding tax is not final. We need to tax it further. How do we tax it further? By adding it to other taxable income. And here you can note, we are told it is net. Remember we said we don't tax net income, we tax gross incomes. So we come here and dividends, Hazina Cooperative Society, the amount is 68,000. Now, when you are told it is net, we said it is after deducting 15% withholding tax. So, meaning this figure is 85%. So, how about 100? Because we tax the gross, the 100 before we, and then we multiply by 100, divide by 85, we have 80,000. That is one. The other income is the dividends from a subsidiary. Dividends from a subsidiary. If you go to the categorization, okay, first of all, let us understand what is a subsidiary. From accounting perspective, we note subsidiary is 50% share. That is what we call a subsidiary. Now, what is the implication? If you go to the categorization of dividend, we said under exempt. If a company gets dividend from another, where it controls 12.5% or more of the share, those dividends are exempted from tax. So meaning, because this company is getting from a subsidiary, those dividends become exempted from tax. We don't tax them. So we cannot add them here because they are not taxable. And what does that mean? Since there is no other investment income, we can now get the total taxable income. So total taxable income would be the operating income, 60, 85, 300, and then we add 80,000. That gives us 61, 65, 300. That is the total taxable statement of adjusted taxable profit or loss for the year 2017, which we have done. So number 2, we are supposed to get the tax liability, if any, for that period. So tax liability. So we have the tax payable, which we call the corporation tax. This is now the corporation tax payable. How do we get? We said once you get the taxable income of a company, you tax the company itself at the corporation tax rate, which were resident 30%, except year 2020 when it was 25, non-resident 37.5%, and those that are under EPZ 10 years, no tax, from the 11 25%. Where does this fall? This one, we are not told it's a foreign company. Whenever you're not told it's a foreign or a non-resident, all companies are resident. And since we are not told about the EPZ and the rest, so in that case we tax it at the rate of 30%. Why? Because it's the year 2017, so 30%. So it's going to be 30% of the taxable income. The taxable income is 165,000. But that is not all. Why? That is 300. That is not all. Why? Because we said if you have an investment income, and that investment income has been added here because the withholding tax was not final, it is a taxable, and it is subject to withholding tax, the withholding tax must be deducted from the tax to be paid. So for here we had seen there is dividend from Hazina Cooperative Society, and we were even told it was net and we had to gross it up. So the withholding tax need to be deducted. So we deduct 15% of the gross, the 80. Otherwise, you can also get the difference between the gross 80 and net 68,000. So how much is that? It is going to be, first of all, we deal with the first one, 30% of 6165, 300. That gives us 1849, 590. And then 15% of 80. The tax, we take the in installment. So it's all about installment tax. Remember we said that corporation tax is usually paid through installment. So what is the first thing that you do? First of all, you have to estimate, which we said is usually done at the beginning of the year, how much installment tax was supposed to be paid in that particular year. How do you estimate? Since this is not a starting company, we said we take 110% of previous year tax. And we can see here we are told the previous year tax was 2,400,000. So previous year tax is that. So, and you also be careful, because you can be given, instead of the previous year tax, you are given the taxable income. So if you're given the taxable income of last year, first of all, convert it to tax, multiply by the corporation tax rate, and then you get the tax of last year, and then you get 110%. But this straightforward, it is the tax of the previous year. So installment tax estimated, because this is an estimate, is supposed to be 110% of the previous year tax, 4,800,000, that is 2,400,000, which give us 110% of 2,400,000. That give us 2,640,000. That is how it is estimated. Then, because you are told to explain, to comment, you must illustrate how it was paid. Once you estimate, we have the first installment. First installment, which we said is supposed to be 25% of the total installment, 2640,000. So we have 25% of 2640,000. That gives us 660,000. When is it paid? You have to illustrate payable by 20th of April. Remember, we already have the year. The year is ending on that 1st December. So it started in January. So the fourth month is April, and the year in the year of income 2017. Then we have the second installment, another 660,000. Remember, another 25%, 660. It's the same because we had already computed. When is it payable? Payable by 20th of June, the 6th month, 2017. And then the third installment, another 660,000. When is it payable? Another 25% of this one, give you the same. So which is payable by 20th September, the 9th month, 2017, in the year of income. Then we have the fourth installment, another 660,000, 25% of the total, which is payable by 20th December 2017. By that time, you'd have noted you'd have paid 100% of the total installment, because 25, 25, 25, 25, you add this one, that give us 802 negative, but don't write a negative. It should be an absolute figure. Why? Because you already have indicated it's a refund. So don't write a negative. It's a refund when it's a negative. And when is it supposed to be done? So by is supposed to be refundable, that is the expectation, by 30th April the following year, 2018. And that is how we do an installment tax. We have also done the corporation tax, and if you look at the question, that means that we have answered Roman 1, Roman 2, and Roman 3, and that is the end of it. So that is bring us to the end of today's lesson about corporation taxation of the limited company, corporation, and installment tax. So in our next lesson, we are going to look at the taxation of the group of companies. Yeah, so, but I want to give you some few questions you can look at just to be able to practice on what we have done here. And the first question is November 2018, question number 2A. November 2018, question number 2A. The next question is November 2017, question number 5B. November 2017, question number 5B. So those are the questions that you can look at for your own practice, and the answers are here in our CPA Advanced Level Revision Partner, Advanced Taxation. So for any reference, in case you want to confirm whether you are right or to follow up, then you can get the answers from here. So I want to hope to see you in our next lesson, where we look at the taxation of the group of companies. But for now, see you in our next lesson. Thank you very much.
Hello and welcome to the lesson. Today we are going to discuss the elements and types of a business strategy under the topic strategy levels and intent. During the last lesson, we analyzed the corporate strategy, and by the end of the lesson, we should be able to discuss or outline the elements of a business strategy and the types of business strategies. Welcome to the lesson. Business strategies. Business strategy. Now, business strategy is also known as the competitive strategy. It is also known as competitive strategy, and this strategy focuses on how company competes within a specific industry or market segment. Focuses on how a company competes. It focuses on how a company competes in a specific industry, or a specific market segment. It is also known as competitive strategy. And unlike the corporate strategy, which we discussed last time, which deals with the overall direction of the company, a business strategy is concerned with gaining a competitive advantage over rivals within a particular business unit or product line. Do you understand? The corporate strategy deals with the overall direction of the company. The business strategy is concerned with the gaining a competitive edge or advantage over rivals within a specific industry or a market segment. So what are the elements of a business strategy? Elements. What are the elements of a business strategy? The first element is competitive advantage. Competitive advantage. Business strategy aims to create a sustainable competitive advantage, which is something that sets the company apart from its competitors and allows it to outperform the competitors in the long run. And that could be based on cost leadership. That means offering lower prices. It could be based on differentiation, which means offering unique product targeting a specific niche market. Competitive advantage. Another element is target market. This is an element of a business strategy. Target market. Business strategy involves identifying and understanding the specific target market that the company aims to serve. And that includes analyzing customer needs and preferences, as well as understanding the competitive landscape, doing what we call competitor analysis to understand the niche or the market. So that is an element of business strategy. 3, value proposition. Value proposition. Value proposition is an element of business strategy which defines the unique value of the company customers. This is the reason why customers should choose the company's products or services over those of the competitors. That is what we call value proposition. Another element is the marketing mix. Marketing mix is an element of business strategy. Business strategy involves developing a market mix that effectively communicates the value proposition to the target market, and that includes making decisions about product features, promotion, distribution channels, pricing, and so on. Market mix, product, promotion, pricing, and distribution. That is an element of business strategy. 5, operational efficiency. Operational efficiency. Business strategy focuses on improving operational efficiency to reduce costs and improve profitability. And that might involve streamlining processes, optimizing supply chains, or investing in new technologies in order to improve operational efficiency. So these are 5 elements of a business strategy. 1, competitive advantage. 2, target market. 3, value proposition. 4, marketing mix. 5, operational efficiency. Let's now outline some of the types of business strategies. Types of business strategies. Types of business strategies. The first type is cost leadership strategy. Cost leadership. Cost leadership. This strategy aims to become the lowest cost producer in the industry, and it allows the company to offer lower prices than competitors while still maintaining profitability. Cost leadership. Number 2, differentiation. Differentiation is a strategy that focuses on, you understand? Uniqueness. This one refers to the uniqueness of products, uniqueness of a service, so that customers are willing even to pay a higher price for its uniqueness. Focus is a type of business strategy. This strategy involves targeting a specific niche market segment and tailoring products or services to meet their unique needs. Do you understand? So these are 3 types of business strategies. We've identified 5 elements of a business strategy. And candidates, the ultimate intent of business strategy is to achieve superior performance and superior probability within a specific market segment. And that involves making strategic decisions that align with the company's overall goals and objectives, while also responding to the competitive dynamics of the industry. So business strategy provides a roadmap. It provides a roadmap for how the company will compete and win in the marketplace. So that's how it differs with the corporate strategy. This is your homework. Business strategy and how are they interconnected? 2, what are the key components of a successful business strategy and how do they contribute to achieving a competitive advantage? 3, how can a company use SWOT analysis that a company can choose from, and what factors influence this choice? In our next lesson, we are going to study operational strategy. Bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year 1 projected project cash flows is 25 million. The annual cash flow growth rate from year 2 is 10 million. The project life is 5 years. You are required: A, compute the following project metrics. Payback period, number 1. Number 2, the net present value, assume a discount rate of 12%. Number 3, the profitability index, assume a discount rate of 12. Totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. given to us over here. And this solution over here, you can just drag this one down over here. This is A, and this gives us year. So we have the years given to us. They're from year 0, 1, 2, 2, and of course you know what happens. Once you put it like this and then you have that plus sign like that, you can drag it up to the number of years you actually want like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5. And you can be able to see the project life right over here is 5 years. So from year 0. And we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings. So shillings, put shillings. And we are saying we can put them in thousands. That. All of these need to be put in terms of thousands over here. That. Why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presented, presentable, I mean. So initial investment is that. Then we have the residue value or residual value. That. And the residual value is assuming that you sell the asset at the end of the project or after 5 years there. So right here I can put over here in terms of the residue value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. Cash flows. And you're saying the cash flows over here we've been given, the initial investment is 100 million. You're saying the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter, it can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're saying is 25,000. Not right there. You can put, because this is the residue value, the cash flows here, 25,000. That. And we're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that. And we make sure at least it auto-fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then. So here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, we're just going to pick the residual value plus the cash flow itself over here, if any. So that now it, after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we're going to pick plus that value plus this net cash flow here comes to 75, and then we reduce it, we continue, we drag it because it's just got a formula, we continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion, or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing A part 1. So this is A part 1. I can just put it like so. This is A part 2. A part 2, like that, so that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that, copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this, copy, put it just down here like so, and this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there, no problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are going to we're going to discount and get the present values right over here. So present values, so the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or there's in Excel, there's always a way we can be able to get the present values. Always, there's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4, and power 5 like that, we can just go to the to a formula NPV like that, and we are saying we open it up right here and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there like that. That's the initial cash outlay. So that's what we're saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,099. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here, that. So these represent the net cash flows. So this is what we're seeing is shillings, so just delete this and it's okay. But the initial investment picks from here, the net cash flows, that value there. So once we have that, then we can be able to get the profitability index. And the profitability index, we are going to get the present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here, like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0, is where IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around there about. So he picks arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth, like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there, I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that, 14%, 15%, and so on and so forth. Just come and change here, 16%, 17, that, then 18. So don't worry about that. 19. Then here we got 20%, 20%, like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center. Make it
1.5 itakuwa saa 4, si ndivyo? So ni hadi saa 4. Si 1.5 ni hivyo. 1.5 itaisha saa 4.
Just place it somewhere right here. That at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the business and data analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye bye.
Hello and welcome back to the lesson. In today's lesson, we're going to study the variable framework criteria. That is a strategic analytical tool designed to help organizations assess the competitive potential of their internal resources and capabilities. The variable analysis is a framework that organizations can use as a strategic analytical tool to help them assess the competitive potential of their internal resources and capabilities. This tool evaluates resources and capabilities based on 4 key criteria. The first criteria is value.